Howdy, Jacob here. Today we're looking at Digi International in the communications equipment industry. Just under a billion market cap, just over a billion enterprise value, under a billion companies. I like to look at insider ownership, and we see 2.3%. Not as high as I'd like it, but not going to entirely turn me off of the business. We do see immense growth here, over double revenue of the last 10 years with increased gross and operating margin. I like that. Gross margin is now mid 50s. Operating margin hitting double digits is very nice. Return on invested capital is not very impressive, though. So reinvesting back in the business, they could still be growing a lot, which could be hindering that figure, but looks like their margins are decent. So I'd be expecting a larger return on invested capital for sure. Could be a capital intensive business, though, which could dampen that figure. Their income statement, they do have R&D spend. It is 10 to 15% of their revenue. So they are reinvesting, taking money away from today to hopefully get more in the future and become more efficient. Their balance sheet shows 32 million cash on hand with 16 million short-term debt, 188 million long-term debt. Looks like they made a big acquisition in 2022, which you can see through goodwill and other intangible assets increasing quite heavily. 2022, a 348 million acquisition, and it looks like they funded it through debt, which we also saw on the balance sheet. And it doesn't look like it increased their free cash flow very much. So that's not fantastic. If you buy a business for $350 million, I definitely want to increase free cash flow, 35 million maybe. That'd be a 10 times free cash flow. But again, it could make their company more efficient down the road. They're still figuring out the ropes to be more efficient. Could very likely be the case. And their use of cash, mostly acquisitions, a little bit to debt pay down recently. Outside of that, in the last 10 years, 5 years, there really hasn't been any other form of reinvestments outside of few reinvestments, but outside of that allocation, it's mostly just acquisitions and debt pay down. So let's get ready to make some assumptions here. Revenue growth has been very impressive, hugely impressive from 2018 to 2023, but most of that growth has been through acquisitions. Again, I think they can do acquisitions, but I don't want them to be going into debt. When I project for a company, I presume about 100% capital allocation, with some actually going to debt reduction, given the fact that they might have more debt than I would like. So for them having almost 200 million in debt in relation to 30 to 40 million in free cash flow, that's a lot. So I will be assuming some capital allocation goes to debt reduction, anywhere from 20 to 40%. So on the revenue growth side, that leaves maybe 40 to 50% for acquisitions, since they do use a lot of money for acquisitions and reinvestment. So this is really all the capital that's not being used for debt pay down. So I think that they can get some pretty good returns, but because they're growing inorganically, I don't think they deserve a premium above the market. And for margins, I think I'm comfortable going with something like 6 and 8. And share changes, their stock-based compensation, 14 million, is going to be, let's say, 1% increase. So we're saying the company's stock price needs to fall 74% before you get the return we're looking for here. Not every company we review is going to be a good deal. And I mean, we see a 58 PE with one of the best margins they've ever had. And for me, I like to be conservative. I like to look at the average of what the history has said, and not assume that everything's going to be peaches and butterflies forever. And it might be, if you truly understand this business, you can likely get to a figure that you're more comfortable with. But for me, based on my initial review of the figures, this is what I'm seeing and I'm comfortable with. And I'm saying it needs to fall 74%. So I'm going to be sitting back for a little bit longer, reviewing other companies that are a lot better deal in the meantime. Thank you, and I hope you enjoy the video.